Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up and ready for you to watch. Now, I want to talk with you today about what is going on with the oil market and what the impact on Biden's decision last week to release the Strategic Petroleum Reserves is likely to have on the price of gas and on the financial markets themselves. What is going to happen with energy stocks in particular and commodities? Before we get into that, you got to understand what the Strategic Petroleum Reserves are and how big this decision really is. So on Thursday, Biden made this announcement. He said he's going to release on average 1 million barrels a day of oil into the markets. The goal is to lower the price of oil and therefore lower the gas prices at the pump. Because let's face it, rising gas prices are hurting the poll ratings of Biden in his political party. And we got a midterm election coming in November. And this release is for 6 months, really going into November, which is kind of interesting in itself. We're talking about a total of 180 million barrels of oil in this release. It's going to be the biggest strategic petroleum reserve release in history. Now, there have been other uses of it in the past. For example, during the Iraq War and when there was a disruption of oil supplies with Hurricane Katrina, when Bush was president. The reserves were created in the 1970s as a response to the oil embargo back then, and they amount to 568 million complete barrels of crude stored in underground salt caverns in Texas and Louisiana. So when Biden's going to release 180 million, he's not releasing all of them. It's just a fraction of the reserves, and it's going to happen for 6 months. Now, it is unprecedented, and it's going to take from now about 10 days for it to enter the market. It should lower the price of oil. That's the expectation. But I think any such effect is going to be very limited and short-lived and not really change the dynamics we're actually seeing in the energy market itself, and probably not even have that much of an impact on the stock market one way or the other. Now, to explain why I think that's the case, I've got to show you the charts of various markets that I'm looking at. What I do is I trade stocks, I invest in sectors of the market, and to make these sort of decisions, I look at charts in fundamentals, valuation metrics. But charts are what are called a technical analysis view of the markets. I kind of combine both technical and fundamentals, but I got to show you the charts, the price action, to show you what is really going on here. And what you're seeing here is a simple chart of crude oil, and crude fell back down below to $100 a barrel last week on Thursday when the announcement was made, but it held the $100 barrel thing, went up the next day. So I would say the short-term impact of the decision is very limited, and markets are forecasting mechanisms. So the price of crude oil would fall before the gas prices fall. There should be an immediate impact if this decision was going to have a huge impact on the markets. And it's very limited, as you can see here. In fact, the price of oil itself has been going up for over 12 months. It was $60 a barrel, $60 a barrel last year, went up to 85 in November, dipped back down to 65, but it was trending up for almost a year, almost 2 years before the Russian invasion of Ukraine happened. So that Russian-Ukrainian invasion, you could see from the chart, helped oil go, let's say, above $90, but it was already at 85 in November, is already in a bullish trend in which the oil market was making higher lows and higher highs since it bottomed in the spring of 2020. And when you look at energy stocks themselves, for example, we'll look at Exxon, which I actually own a position in. Exxon hasn't even dropped at all since the announcement was made. So there's no indication in the financial markets that the energy stocks or the energy price of oil is being impacted one way or the other by this announcement that the oil reserves are going to be in play for 6 months. Why is that? Well, because there's more than when people invest in a stock, they're not, unless they're a day trader, they're not just thinking 6 months ahead. They're thinking 12 months ahead or even longer than that. So 6 months is just a temporary, increase of oil on the market, replacing supply that's already been taken away because we're not getting the oil, or the world's not getting the oil, or Europe's not getting the oil, the West isn't getting the oil that they were from Russia. And it's not even making up for that complete shortfall. Yes, I think we can say that the oil, this release, this decision will, if it wasn't happening, probably oil and gas prices would go up even more than they already are. So there is some sort of impact, but it's not a game-changing impact. It's not causing a bear market in oil. It's not causing oil stocks to sell off at all. So the impact has been very minimal, and it's a news item that's coming and going. And the real biggest reason for all this is because the rise in energy prices, as I said, began, well over a year ago, and it's tied to not just the war in Ukraine, but a macro inflationary trend that became obvious to people last year when inflation data started to tick up. It didn't just start with the Ukraine war. And even today, the price of corn is trading at a new 52-week high. This is the corn ETF, CORN. And that's just one commodity up today. So commodities are going up, commodities in a bull market. This news item is not stopping that bull market in commodities. And that's why I believe that now and for the next several years, a way to invest, a way to make money, a way to beat the performance of the averages is to have investments tied into this underlying inflationary trend. The release of the oil reserves is not stopping that underlying inflationary trend at all. And if you want to beat the markets, you want to align yourself with the big trends. I think the situation in the markets is very similar to much of what happened in the 1970s. If you look at the 1970s, REITs, energy stocks, mining stocks, material stocks were the best sectors to invest in. And today, REITs are among the top performing sectors of the market, and so are all the other ones I just mentioned. And I don't think that's going to change anytime soon. These are trends that are going to last for years. How about the stock market? Well, if we just look at the S&P 500 today, it's down 32 points. It fell below the 200-day moving average as the NASDAQ fell even more, and then it's bounced back above it. It's sort of in a no man's land, so to speak. When you see something bounce up, straight up, like this did in the second half of March, typically what will then happen is you'll get a few weeks of sideways action before the next meaningful move actually happens. So I think that's what we're likely to see. And you can see on Thursday, the news of the release of the petroleum reserves had no measurable effect on the S&P 500, and you can't see any ever since then. So the effect on the markets is very minimal. It's a news story that's going to come and go. The technical picture of the market is more important. And that is, as I said, we had a drop, we bounced, and now we're in sort of a pause period before the next meaningful move happens. Whether that move is up or down, you can't really tell from just looking at this chart. But there's a lot of reasons to think it's not going to be an up move, at least in any meaningful way. One thing that is happening today is bonds are once again going down. This is the ETF that tracks the 20-year Treasury bond, down today 2%. And that's because inflation is real and interest rates are going up. And the release of the petroleum reserves is not stopping that. If it was, then bonds would be rallying on the news, and they're not. So don't get caught up trying to really do much of anything based on that news from last Thursday. The news has come and gone, and it's had a minimal impact on the markets. It's not a reason to be bullish. It's not a reason to be bearish. It's a reason it's news to be ignored, frankly. I hope, yeah, it will. Gas prices could go up more than they would if it wasn't happening, but it's not really having a bearish impact on commodities, oil, energy stocks, or much of anything else. So those are my market thoughts for today, Tuesday, April the 5th. I'm going to try to hook up an interview with David Skirika tomorrow and see what he thinks about what's going on. We haven't done an interview in several weeks. But if you like this information, click like. That way YouTube will know to show it to other people. And if this is the first time you've ever seen me on YouTube, click the bell and click subscribe. Click subscribe, then click the bell, and then YouTube will send you an alert as soon as the next video is up. All that said, have a great trading day the rest of the day, and we'll see you in the next video.